Chapter 5. Your First Stream. Success in the Stock Market. Investing for Total Idiots. In Chapter 2, I shared with you the 7 secrets of prosperous people. The first 3 were 1. Value it. 2. Control it. 3. Save it. In this chapter, you will be learning the 4th skill. Invest it. Investing is distinctly different from the 5th skill, making it. Investing is primarily a passive process. It doesn't involve the active buying and selling of products or services. It simply involves the buying and selling of passive financial instruments, such as stocks, bonds, options, certificates of deposit, and so forth. To be a great investor, you don't have to transact business in the normal sense, and you don't have to deal with people. You can be anonymous. You can do everything from behind a computer screen. Although investing can be done in minutes a day, the results are accumulated and compounded over long periods of time. It is such an important skill that I've included it in the mountain range of wealth as the investment mountain. If the investment mountain is characterized as passive, then the other 2 money mountains, real estate and marketing, are definitely more active. They are the making it mountains. They involve active participation for months, even years, to get their streams up and running. You have to deal with people, negotiating and persuading and marketing. More about these mountains later. First, let's master the investment mountain. I'll make the assumption that you are following the reservoir model and that your survival account is now fully vested with 3 months of emergency cash. A consistent 10% of your income is available to flow into the remaining investment basins. Now you're ready for the markets. Let's explore the myths and realities of the world's financial markets. As I said in Chapter 4, there are thousands of stocks and mutual funds to choose from, and the data about these investment vehicles is changing every minute of every business day. You can't know it all, so don't even try. Don't let the overwhelming amount of data cause you any concern whatsoever. Focus only on your 3 simple tasks: filtering, timing in, timing out. These 3 tasks represent the 3 critical questions you need to answer if you're going to be extremely successful in the stock market. How can I know which stocks to buy? Filtering out the good ones. How can I know when I should buy them? Timing your purchases. How can I know when I should sell them? Timing your sales. This chapter will answer each of these critical questions. When you finish reading this chapter, you're going to feel confident and well on your way to stock market success. But let's pop your bubble before we begin. I don't want you to entertain the notion that you're going to learn how to beat the market. By beating the market, I mean being able to pick a set of stocks or mutual funds that will outperform the traditional indices, such as the Dow Jones Industrial Average, the S&P 500, or the Wilshire 5000. Which are the traditional thermometers of the investment world. When you listen to the news, you will constantly be hearing phrases like this: the Dow is up 100 points. The S&P 500 was off 5 today. The broad averages were mixed. The Wilshire 5000 has been trending sideways for several weeks. Just what are these benchmark averages, and why should you care? The Dow Jones Industrial Average, DJIA, is a complicated formula that represents the average of the stock prices of 30 of the largest companies on the New York Stock Exchange. Example, General Motors, Walmart, Disney. It's often confused with representing the entire market of over 10,000 stocks. The S&P 500 is the average of the top 500 companies from all of the 3 stock exchanges. The S&P 500 is just a broader snapshot of the entire market. It represents companies that are worth about 75% of the value of the entire stock market. And the broadest view of all is the Wilshire 5000, a composite of all stocks of the top 7,000 companies. All told, there are over 10,000 stocks to choose from, including many over-the-counter stocks not yet listed on one of the 3 major U.S. stock exchanges: New York Stock Exchange, American Stock Exchange, and NASDAQ. Of these 3 averages, the one to beat is the S&P 500. A money manager looks like a genius if he or she can make his or her portfolio of stocks produce a higher percentage return or a lesser loss than the percentage return generated by the S&P 500 average. You may be surprised to learn that 75% of all of the smartest money managers in the world, working 20-hour days with huge research staffs, powered by the most advanced computers, have not been able to consistently beat the market. Of the remaining 25%, most were just able to keep pace with the market, but when you factor in commissions and fees, you're still a net loser. A handful of the rest, and I do mean a handful, were able to beat the market by a substantial margin, but to pull off this feat year in and year out is next to impossible. You have to be an outright genius like Warren Buffett, or someone possessed with uncommon common sense like Peter Lynch, now retired, or believe that God is on your side like Sir John Templeton, now retired. In the history of the markets, only a tiny number of long-term superstars, out of millions who have tried, have been able to tame this tiger. That's why they are so famous and so rich. You and I, with our puny brains, are not going to best the best of the best. So give up on that notion. It'll save you a lot of sleepless nights, money spent on investment advisory services, countless hours studying boring stock market tables, or precious minutes perusing exciting stock market newsletter offerings. Some people, a brilliant lucky few, might be able to beat the house, but the odds against you and I doing it are lottery-like. Let me say it again. You can't beat the market. Give up now before you begin. As Ashley Brilliant said in one of his cartoons, I feel so much better now that I've given up hope. Having said this, I know that if you are a naturally competitive person, you don't want to believe what I just said. You want to be the next Peter Lynch or Warren Buffett. Okay. In the next 2 chapters, I'll show you some ways to take some of your high-risk money, say 20%, and perhaps hit a home run or two. But for now, let's be content with walks, bunts, and singles. Notice that I didn't say you couldn't make money in the market. In fact, you can make huge amounts of money in the market. In the long run, it's probably the surest way for you to amass an extra million or two in your lifetime. The road to winning. I'm going to show you a method for winning in the stock market. It's the idiot's approach, the lazy way, the simplest way. Ironically, the best way. Study Figure 5.1. It shows the history of the stock market for the past 50 years. This chart contains all you need to know to be a consistent winner. You should deduce 3 powerfully obvious lessons from this chart. Obvious lesson 1. The longer you invest, the lower your risk. Suppose you happen to sink your entire inheritance into the market at the top of one of the peaks, just before a huge dip. With the hindsight of history, it's obvious that the storm was eventually going to blow over. It didn't seem so at the time, I remember. That's the year I graduated from college and the storm was still raging. The best strategy would have been to just strap yourself to the mast and hold on through the gale. This would have brought you through safely to a continuing cadence of escalating profits. You can always win if you just hang on long enough, every single time. Will this trend continue into the future? Who knows? At worst, the market could collapse into a steep decline from which the world will never recover. Sounds ridiculous, doesn't it? Considering all this bloody century has seen and survived. Maybe the market will take a breather and languish for a decade. That sounds more plausible. But even so, if you give yourself a long enough time frame, the overwhelming odds are that things will eventually improve and keep on improving. That the shorter your investment horizon, the greater your risk. Suppose you got into the market and things started to look bad. Instead of holding for the long run, you got spooked and jumped out after only a year. What would be the odds of your success? From 1950 through 1999, there have been only 11 years in which the overall market, as measured by the S&P 500, lost ground. That's about 1 losing year for every 4 winning years. Over 3/4 of the years have been winners. What does that tell you? The odds of winning are in your favor. Nonetheless, on a short-term basis, you have about a 22% chance of losing all or part of your money. 1 chance in 4. Russian roulette with a 4-chambered handgun. That's too high a risk to take in the short run. If you could hold on for 5 years, you would lower the risk of loss to about 15%. There were very few 5-year periods in the past half-century in which you would have ended up with a net loss. If you hold for 10 years, the risk of loss is less than 1 in 20. The same logic holds true for 15, 20, and 25-year holding periods. The longer you invest, the lower your risk. In fact, a 25-year holding period has been shown to give you a zero-risk situation. Would you like to invest your money without risk? Then the most important decision you could make today is to get into the market and stay there for at least 25 years. Lock that decision in your mind and throw away the key. Take a lesson from the smartest stock picker in history, Warren Buffett. My favorite holding period is forever. That's why Buffett is a billionaire and your stockbroker is just a broker. We just answered one of the 3 critical questions for the beginning investor who was planning to put some money into the stock market. Question: when should I sell? Drum roll. The envelope, please. Answer: sell somewhere between 10 and 25 years from now. If you're not going to do this for the long term, don't start. Get used to the idea of arriving in the future and having no money there to greet you. Obvious lesson 2. If you can't beat 'em, join 'em. In the past 10 years, out of 6,000 plus professionally managed mutual funds, only about 20 were able to beat the 10-year performance of the S&P 500 after expenses and fees. They deserve honorable mention. Just because they made the list this year doesn't guarantee that they will continue to be on the list. Whenever I mention this short list of winners, people always perk up, for the wrong reasons. The lesson is not to bet your money on the top 20 rabbits in the race. The lesson is that 5,980 other rabbits, racing with all their might, couldn't outpace the lowly tortoise. The risk of picking the right rabbit in 6,000 is ridiculous, compared to the no-brainer of simply placing your bet on the tortoise. In stock market terms, what is the tortoise? It's the S&P 500. By now, you've heard of index funds. One of the most popular index funds is a special mutual fund made up of all 500 stocks in the S&P 500. What a great concept! If you can't beat the market, then buy the whole market. Bet that the entire market will continue to go up, in the long run, of course. There are so many advantages to investing in index funds compared to the average professionally managed equity mutual fund. Index fund. Lower costs, 0.2%. Low portfolio turnover. Low transaction fees. Low tax consequences. Professionally managed mutual fund. Higher costs, 2% or more. Higher portfolio turnover. Higher transaction fees. Higher tax consequence. For the average unsophisticated investor, the no-brainer approach is to buy a few carefully selected index funds and forget about them. Here's the answer to another of the 3 critical questions. Question: which stocks should I buy? Drum roll. The envelope, please. Answer: all of them. Buy an index fund made up of all the stocks in the market. Table 5.2 shows a few examples. Odds are, with this approach, you'll do just as well as the vast majority of professional fund managers and perhaps much better. You don't have to agonize for months over which stocks to buy and when. Just choose one from the following list and forget about it for 10 to 25 years. And that brings us to the final question. When should I buy? Obvious lesson 3. The sooner you buy, the richer you can become. The sooner you buy, the longer you have your money at work, and the more money you have to compound. Take 50% of your monthly savings and sock it away into your chosen index funds. Do this every month without fail for the rest of your life. If you'll do this, even if you do nothing else I describe in this book, then in due time the floodgates of prosperity will pour into your life. The goal of the following chapters is to open those floodgates much sooner. But if all of your short-term, harebrained schemes come to naught, this tortoise strategy will have you slowly giggling yourself towards a prosperous future. And if you're like most folks, you don't have a lump sum lying around. You're forced to invest in periodic payments over time. When you invest a fixed amount every single month for a long period of time, you're actually practicing a rather sophisticated strategy called dollar cost averaging. Fund 2 outperforms Fund 1 by a substantial margin. How can that be? It surely doesn't look that way. The answer is simple. As the price was dropping, The fixed $100 investment purchased a larger number of shares. Even though the share price never reached its starting point at the beginning of the year, the total value of the portfolio increased substantially because of the shares purchased at lower prices. Of course, these are contrived examples, lies, damned lies, and statistics. But if you can clearly see the value of a decline in the stock price, assuming that the price eventually recovers. With dollar cost averaging, you're actually hoping for a price decline every once in a while. It gives you a chance to buy more shares at a cheaper price. That is why you can look at temporary stock market slumps as positive events in your long-term investment horizon. Dollar cost averaging works only if you continue buying, especially during the bad times, and hold on until good times return. If you stop buying during the bad times, you lose your average when things rebound. Here's the number one reason that dollar cost averaging is so powerful. It completely eliminates the need to guess when you should buy. It takes away the need for market timing. What is market timing? If you're really smart or have a lot of time on your hands, you can try to forecast the highs and lows in the market. At the peak, when the market is just beginning to dip into its highs into a trough, market timers say you should cash in your chips and park your money in some risk-free checking account. Then, when the market hits bottom, it starts to bounce back. That is the precise time for you to buy with both hands. Sounds easy, but only a handful of investors have been smart enough to do it. For example, during the entire decade of the 1980s, the S&P 500 index gained 17.6% annually, with frequent dips and spurts. During this period, there were 2,528 trading days. A full 28% of the entire profit for the decade was generated in just 10 days. If you had been trying to time the market and happened to miss those 10 critical days, you would have lost 28% of your gain for the entire decade. With dollar cost averaging, you don't have to be smart. You can be a total idiot and still win. You just buy every month, month after month. You buy during the good times. You buy during the bad times. You don't care what the headlines are saying. You ignore the experts on TV. You don't get jealous when you hear that one stock out of 10,000 tripled in price that day. A lot of other investors also bought the one that dropped by 2/3 on the very same day. You just blindly and ignorantly do what you have always done. Buy, buy, buy. The average price of your continued buying will give you a wonderful average long-term return. This, of course, assumes that the past 50-year history of 11% compounded annual stock market gains continue for the next 50 years into the future. This is not necessarily a sure bet. You'll have to decide whether this is a safe bet for you. Let's review what we have learned. You must start your investing program immediately. Index funds are the safest, simplest way to invest in the market. Dollar cost averaging is convenient and smart for most of us. Long-term investing is far less risky than short-term investing. The question is, how much of your disposable savings should you invest in index funds? I recommend that you put at least 50% of your savings there. What about the other 50%? You're going to spread it into 2 other reservoirs or basins. The information in this chapter is just enough to get you started, but certainly not enough to form a firm foundation for investing. If you aren't interested in the markets and want the fastest, safest, easiest way to invest for the long term, then invest all your money in index funds, and I'll see you in 30 years. You can skip over the next 2 chapters in the book and proceed directly to the real estate mountain. If you're a natural autopreneur, if you love to tinker with numbers and analyze data, if you'd like to learn to think like Warren Buffett, and if you love the challenge of trying to magnify your investment returns, then I recommend that you join me in Chapter 6, where I'll show you how to invest the other, more aggressive portion of your investment portfolio.